What if the safest financial decision of your life is secretly the most dangerous one? Picture this. You're in your mid-40s. It's a quiet weekday evening. No emails, no stress. Just you, your kitchen table, and one final payment. You write a check, a big one. Every dollar you've saved, your emergency fund, old inheritance money, gone. You seal the envelope, send it to the bank, and take a deep breath. It's done. Your house is paid off. No mortgage, no debt, just freedom. Or at least that's what it feels like. You sleep perfectly that night because everyone told you this was the smartest, safest move you could ever make. Now fast forward 6 months, you lose your job, the economy dips, your industry collapses, income zero. You open your bank app and your stomach drops. It's empty because every dollar you had is now locked inside your house. You need groceries, you need to pay the electric bill, your car needs repairs. And suddenly you realize something terrifying. You can't eat drywall, you can't pay a mechanic with bricks. You go to the bank and ask for a home equity loan. They look at your income and say no. No job, no loan. Congratulations. You're sitting on a pile of gold and starving. This is the liquidity trap. By obsessing over being debt-free, you didn't become safer. You became fragile. Today, we're going to destroy one of the most sacred beliefs in personal finance. Paying off your mortgage early is often a financial mistake. Not because debt is good, but because emotion has been lying to you. The fear of debt comes from another era, a time when interest rates were 12, 14, even 18%. Back then, paying off debt was survival. But if you're holding a mortgage at 3, 4, or 5% and rushing to eliminate it, you're locking your money into one of the worst investments imaginable. Ask yourself this: would you voluntarily put your money into an account that earns 3%, has zero flexibility, and punishes you for accessing your own cash? Of course not. Yet that's exactly what extra mortgage payments are. Markets historically return 8 to 10%. Paying off cheap debt gives you 3 or 4%. That gap isn't small. It's lost wealth. Banks get rich on this concept. It's called arbitrage. They borrow cheap and lend expensive. You can do the same thing in reverse. If your mortgage costs 4% and your investments earn 8%, that 4% spread is profit. Kill the mortgage early and you kill the arbitrage. And now let's redefine risk. Risk is not owing money. Risk is not having access to money. Home equity doesn't pay bills. Cash does. Liquidity is safety. When you send extra principal to the bank, that money disappears. It becomes trapped equity, dead money that produces no cash flow and can't help you in an emergency. Meanwhile, someone who kept the mortgage and invested the difference has options. They have runway. They have control. Who's safer, the person with a paid-off house and zero cash, or the person with a mortgage and hundreds of thousands of dollars in liquid assets? The answer is obvious. And then there's inflation, your secret weapon. A fixed-rate mortgage gets cheaper every single year. Your payment stays the same, but your income rises and the dollar loses value. You're paying the loan back with cheaper money over time. By paying off the mortgage early, you destroy this advantage. You give the bank valuable dollars today instead of worthless dollars tomorrow. You're helping the bank. Now here's what most people don't want to admit. Paying off the house doesn't magically turn people into disciplined investors. When the mortgage disappears, lifestyle expands. Better cars, bigger vacations, more spending. The mortgage actually enforces discipline. It keeps lifestyle inflation in check while investments quietly grow in the background. And here's another uncomfortable truth. A fully paid off house makes you a bigger legal target. High equity attracts lawsuits. Debt can act as protection. Liquidity gives you power. So when does it make sense to pay off a mortgage early? Only 2 situations. First, if the interest rate is higher than realistic market returns, that's a guaranteed win. Second, if you know without question that you'll spend the money instead of investing it. For everyone else, low-interest mortgage debt is not a sin, it's a tool. Corporations use it, governments use it, the wealthy use it. Only the middle class is taught to rush to zero, where liquidity disappears and options die. Here's the actionable step. Stop sending extra money to the bank. Send it to yourself. Open a separate investment account. Automate it. Treat it like a non-negotiable bill. Let math, not fear, run your financial life. A paid-off house is a trophy. A liquid investment portfolio is an army. I know which one I'd rather have. If this made you rethink that extra mortgage payment, hit subscribe, and I'll see you in the next one.